Well, welcome back to the Brian Crombie Radio Hour on Saga 960. We just heard from Akbar Zareb, the founder and head of Kingsway Real Estate, about his prognosis for the real estate market in the Greater Toronto Area. And, not surprisingly, I guess it's his business. He's not nearly as negative as I am, and he's reasonably positive about what's going to happen in the real estate market. I want to turn from the real estate market. I'll come back to it as well, but I want to turn from the real estate market to the overall market. Inflation is high, and it would appear getting higher. Interest rates are low and getting higher, and probably going to get a lot higher still. The difference between interest and inflation is still, maybe 500 basis points or so. It's one of the largest separations between interest and inflation in history. And logically, what happens is interest should be equal to inflation because people want to keep their money intact from a real standpoint, and so therefore, at minimum, you should be hoping to get interest equal to inflation. Otherwise, you're losing money on a regular basis, and so I think interest rates have got to go up, and inflation is way above the 2.2% target that the Bank of Canada, the Federal Reserve, et cetera, have. And so with inflation in that 6 to 8% range, and, that's what people say it is. But we all know that gas is up like 50%, housing's up like 30, 35%. So how they actually calculate that CPI, food is up dramatically. How they actually calculate that CPI is only 6 to 8% is frankly beyond me. I think that actual inflation that we experience on a day in and day out basis is substantially higher. I had the experience this weekend that probably lots of you have had. It cost me $300 in gas to go on a trip to Ottawa and back, and like that was outrageous. And it used to cost me, probably less than one tank full in the past, and the tank was less than $100. So it's a pretty astronomical increase in gas prices. And that's probably because of the Russian invasion of Ukraine. But, so is food price increases, wheat price increase. So are some of the supply chain problems. The pandemic, clearly caused problems with supply chain. I saw the statistic that I showed earlier on in the show that supply costs for some goods coming into Canada, the United States, are up 500%. 500%. So difficult to understand how inflation is only 6 to 8. And the only way of bringing inflation down, inflation expectations down, is to slow down the economy, maybe trigger a recession. And that's what the federal bank, the Federal Reserve in the United States, and the central bank in Canada are doing by increasing interest rates. And the market has tumbled dramatically, mainly because people in the United States and in the markets are worried that the Fed in the United States is actually going to have to increase interest rates by 75 basis points. I was wondering a week ago, or when was it, 10 days ago, and I took out some bets with some friends that the Bank of Canada was going to raise by 75 basis points. They only raised by 50. I think in retrospect, the Bank of Canada, particularly if the Fed goes up by 75 basis points, the Bank of Canada might be saying, we wish we had gone up by 75, because obviously we need to do something more aggressive to bring inflation down. The markets have tumbled Friday, Monday. We are in bear market now. The NASDAQ, the tech stocks, are down by something like 32% since their high in November of 21. The Dow industrial and other stocks are not down as much. They're down like something like 16 or 18%. I can't remember exactly what. But we are officially in bear territory. It's interesting, the bull territory that went from sometime in March of 2020 until early January or now, depending on when exactly you call the bear market as starting, is one of the shortest bull markets in history. Hopefully this bear market will also be short. I think that a lot of people were worried about the pandemic and thought that it could lead to a prolonged recession, if not a depression. And that didn't happen. It led to a big slowdown, but then it was the V-shaped recovery that several people were talking about, and it came back fairly fast, mainly because the central banks across the world really put a lot of money into the system through quantitative easing. The government's put money into the system through fiscal stimulus, et cetera, and we came roaring back. Unemployment is now at a almost all-time low. Jobs are still being created. And so clearly what that's going to do is lead to wage pressure. At the same time, you've got inflation, as I said, between 6 and 8%. The World Bank a week ago came out and said that they were worried about stagflation, which is something we haven't had since the 1970s. And then we've had a couple of articles, actually many articles, talk about how the housing prices to disposable income or to rents in Canada are at an unbelievable high relative to the United States. So much so that we are sort of where the United States was in 2008, prior to the financial collapse in the United States, triggered by the subprime crisis. We did not have that collapse in Canada because we didn't have the subprime exposure that the United States had. And so lots of people have been saying for a long time that the Canadian real estate market is overvalued and wondering what was going to happen, but there didn't appear to be a triggering event that was going to have it come down. I think the triggering event is increased interest rates. And if you think about the mortgage stress test that the Bank of Canada currently has, you add those extra basis points onto increasing interest rates, and the interest rates that people have got to withstand from an income standpoint are going to be 5, 6, 7, 8% in the next little while. And that's going to mean that a lot of people that wanted to get mortgages for homes won't be able to get mortgages for homes. I think that people that have got variable interest rate loans, variable interest rate mortgages, and there's a lot of them, home equity line credits, are going to be shocked as the interest rate on their mortgages, their home equity line of credits go up. And I think there's going to be a depreciation in housing prices. I think that the supply challenges that we have currently have been artificially created by municipal governments that haven't approved zoning and building permits and official plans anywhere comparable to what we need. Build has talked about 50,000 or more homes short that we are not building every year. And so that's going to mean that demand is still high, but demand is only at what you can afford it to be. Certainly there are some speculators, and speculation in the industry is probably at a high today, where people are coming in and buying second and third homes and then renting them out, whether they be homes or condos. So that speculation might go down, and that might cause a market depreciation in of itself. But the vast majority of people, I think, buy homes or condos based on what they can afford because they need to live in it. And even if they need a place, if they can't afford something, then they're not going to be able to get the mortgage, and they're not going to be able to invest. And I do think that some of the extra money that's been put in the marketplace by parents or by second loans or second mortgages or third mortgages, et cetera, some of the interest in that's going to go away as there's appears to be more risk in the housing market. So my prediction is that housing is going to come down, and it's going to come down precipitously. We've already seen a slowdown in sales volume. And when you think about sort of economics 101 and the supply and demand curve that we all learned in economics 101 or in high school economics, or we just learned, in street smarts, prices aren't going to adjust right away. What's going to happen, first of all, is demand's going to go down. And to a certain extent, prices have stayed high because supply has gone down. So people, as there appears to be weakness in the market, I think less people are putting their houses on the market. And as less people put their houses on their market and supply goes down, even if there is a depreciation in demand, demand doesn't cause a price decrease yet, but volumes are down. And so therefore, as volumes go down reasonably dramatically, some people have been saying between 20 and 30% in the last month, logically, what's going to happen is people that do need to sell, do need to move, are going to have their houses left on the market longer. I've been inundated with people sending me emails about new price and price reductions and good price opportunity. That's going to happen more and more. People are going to reduce their prices, and then it becomes a self-fulfilling prophecy. So I think that the housing market is in for more than a dip. It's in It may not be a bust. It may not be a bubble burst, but it's going to be a depreciation. And I predict like 20%. That's what happened, I understand, in the early 1990s. No one expected it, and it happened. Lots of people didn't expect, most people didn't expect the collapse in the United States, even with the subprime crash. And you know that there were, based on the movies, there were people betting, shorting the market and betting that there was going to be a crash, and they almost ran out of money because the market all believed it was going to go on forever. So just because everyone believes, and smart people like our guest earlier today believe it's going to go on forever, doesn't mean it actually will go on forever. And frankly, that might be the froth at the top of the market. I had a really good presentation that stuck with me forever by the chief economist of the Royal Bank at one point in time, who said, when people are buying stocks or houses on credit cards, you know, that's the time to sell. I think people were stretched to the limit and buying houses on, if not credit cards, on second and third mortgages. And the market was so frothy, and we all knew it. Price increases were outrageous, and we all knew it. That's when you reach the top, and it's going to come down, and it's going to come crashing down. So I am reasonably negative about the economy. I think that housing's going to go down. I think the stock market has gone down. It may continue to go down. I think that interest rates are going to go up, and they're going to go up precipitously. And I don't have a lot of confidence that the Fed and the Bank of Canada are going to be able to do this with a soft landing. They don't achieve a soft landing very often. So I think there's a good chance that we have either stagflation, which is what the World Bank is worried about, or a global recession, which is what the World Bank a week ago said it was going to be very difficult to not incur. What does that mean? That means stay in cash. That means be resilient. That means get prepared for some tough times. And then, frankly, as Stephen Harper famously said in 2008, and he got ridiculed for it, but it was actually pretty good advice. At some point in time, it's going to be the time to buy, because as things go down, they're not going to go down forever. And as if you've seen the charts in the United States, the housing is back up to where it was in 2007 at the high. So things are going to go down, which is going to create a buyer's opportunity. And so therefore, hold on to your hats and stay in cash for a while. And then in a little while, it may be time to buy. Anyway, for what it's worth, that's my prognosis for the market. Good luck, everyone. Good night. I'm on to remind you every night, Monday through Friday at 6 o'clock on Saga 960. You can stream me online at saga960am.ca. You can get me on 960am. You can get my podcast and video casts on my website, briancrombie.com. My videos are on Facebook, Instagram, YouTube, and LinkedIn, and my podcasts are on Apple, Audible, and Speakeasy. Good night, everybody.